you go. Hello. Hi, everybody. Thanks for making it out for a morning session talking about security tokens. Thanks to EthCC for having me today, and actually thanks to Adam from Polymath for giving us a good primer. I'm going to be talking about a lot of the same themes, but we'll be going into a little bit of a more technical deep dive into one specific application of security tokens, especially centered around real estate. So I work on a project called Meridia, which is a consensus project to move real estate equity, debt, real estate funds, and REITs to security-backed tokens on Ethereum mainnet. Today we're going to be talking about a little bit of my background and kind of what we've been doing in the space. We started out in 2017 when nobody was talking about security tokens. Everybody was talking about ICOs and token economics and TCRs. And we were like, hey, you know, traditional capital markets can really benefit from this technology as well. We should be paying attention to this. Lo and behold, you know, the ICO cycle kind of went through a bust period, and then now security tokens are kind of ramping up as one of the next waves of digital assets that are going to make it onto public blockchains. So I'm going to touch a bit today on why security tokens are interesting, and then how we're using them at a very low level, specifically around compliance for different trading restrictions that are traditionally put on these securities. And then we'll end with just looking ahead at where the ecosystem is today and where we see it going over the next couple years. So first, a little bit of my background. So I'm Corbin. I lead the technical side. So, you know, if you want to get into the nuts and bolts of Solidity, I'm happy to do that. My background is in kind of the traditional financial services sector. So I spent several years at some large hedge funds, first Bridgewater and then Millennium, basically corralling a bunch of trade data from different trading venues and different types of derivatives that were being traded all around the world. You know, what I always like to say is if you're a crypto trader and you have trouble doing your taxes at the end of the year because you have, you know, trading data across a couple different exchanges, a couple different DEXs, imagine being a global hedge fund that trades on markets around the world where there are absolutely no standards, and you're trying as best you can to get a real-time view of risk, compliance, and trading activity across all that massive data set. That is what the traditional financial services industry is grappling with today, which is why blockchain is so exciting for providing a little bit of a better way where you have one central ledger that has all trading activity. That's what excited me about the space originally, and I joined Consensus at the beginning of 2017 to kind of help bring that vision and make it a reality. So what is Meridia overall? So we basically try to take the entire life cycle of a real estate asset and put as much of that as possible on chain. We started off thinking specifically about title, doing a couple projects in Dubai, Singapore, and India, but quickly learned that, you know, title is a big regulatory challenge and is probably years and years away from actually making it onto a public blockchain. We then looked at things like leasing, like capital markets activity, like real-time accounting for these real estate assets, and tried to compile as much of that as possible into Meridia. The reason we're focused specifically on real estate assets is because we believe that they can benefit the most from blockchain technology. Specifically, the fact that they are inaccessible today. It's hard to get into these assets. They're illiquid. It's hard to get out of your position if you are lucky enough to get into, you know, a hot commercial real estate deal. And then lastly, just the transaction cost of doing these different trades is incredibly high. There are a bunch of brokers, lawyers involved, when it could be as simple as a token transfer. Essentially, we're a three-sided market that connects property owners with investors, and then we have service providers, whether that's brokerages, due diligence providers that kind of fuel the ecosystem. Our application is live today, so we tokenized our first asset midway through last year. It's a multifamily asset in Brooklyn, actually not too far from our office, which is really exciting. You can see here, this is the investor view of logging in and seeing your portfolio of all the assets that you hold. We also have built out some other cool tech, and I'll go through the smart contracts for these a little bit later, but you can do P2P swaps, exchanging what we call our asset tokens, which are real estate-backed tokens for stable coins like DAI. We were one of the first applications to incorporate DAI into the platform itself. And then on the property owner side, if you tokenize your cap table, you then get a real-time view of how that token is trading, how your cap table is trading over time, and then we also automate a lot of kind of the traditional security management functionality, like sending out quarterly briefings, updating your investors on new activities, and all this is done in a digitally native form. And then lastly, one of the real benefits of tokenizing securities is providing a secondary market. So existing investors have a trading venue. Even if it's not a full exchange, it could just be kind of a bulletin board operated venue that allows you to post and say, hey, I want to get out of my position. All the other investors that have been whitelisted for that particular asset will get notified and can then fulfill the other side of that trade if they'd like to. So I'm going to touch on this probably pretty quickly because I think Adam covered a lot of it as well. But why are security tokens interesting? The first is just the fact that they're absolutely massive. If we look at the cryptocurrency market in relation, even US equities or even the cash that Apple has on hand just completely dwarfs the entire cryptocurrency community. Even the circulating supply within the world of traditional currencies is so small compared to just US-based equities, and that doesn't even include a massive amount of debt products and then also a massive, massive amount of derivatives. And so if we want the maximum amount of value to be put on public blockchains like Ethereum that we all care about, excluding derivatives, debt products, equities is just almost just silly. If we want this to be kind of maximally impactful. The other one, and this is kind of an ethos that's been floating around the crypto community since its beginning, is just the fact that blockchain can serve as the internet of value. Over the past 30 years, we've had the information internet rise, and now you have amazing tools for indexing the world's info. But our most valuable assets, whether that is land, whether that's equities, whether that's derivatives, are hard to find, right? They're in silos, they're in exchange-based trading venues, they're in online brokerages, and they're not in really a digitally native form. There's no underlying protocol where all value can be transacted back and forth. And a lot of us got into the blockchain ecosystem because we believe that this new layer is that internet of value. So this is what it looks like today. This is a little snapshot of our application of the first asset that we tokenized. You can see it has 14 different investors. It was just a private placement deal for this asset in Brooklyn. And here's what it looks like on Etherscan. Right, so full cap table visibility on this public blockchain. Anybody can go in there and see how it's trading back and forth. Anybody can write web applications to work on accounting or tax applications on top of this. This is kind of the future that we're working towards. So I'm going to dig into our smart contracts at a pretty granular level up here next, but I think this graphic does a good job of kind of summing up how we view this system from a high level. So up there at the top, traditionally you have two sides of a trade, the buyers and the sellers, and you usually have 3-day settlement times and clearing brokers that are involved along the way. And then at the end of the month, you have this army of accountants and auditors that come into your office. They take up a huge conference room and go through all your trading activity to make sure everything was on the up and up. And then they usually are bothering quite a few people in your back office if something isn't checking out, and you have to kind of dive into the nitty-gritty. What blockchain and smart contracts kind of allow you to do is to take that reactive, auditing functionality and actually make it proactive by checking off all those different compliance steps before a trade takes place. And I'll go into that in a second. The common ones are, of course, whether an investor has been whitelisted to trade a particular security, but there is a whole lot more logic that you can kind of automate beyond just whitelisting. So what does the Meridia smart contract architecture look like today? So I'm going to be going through our diagram here shortly. So I'm going to start out here at the bottom where we have our proxy tokens and our asset tokens. So all tokens on the Meridia platform are upgradable. So we have a proxy in front of it so that you can kind of switch out a version at a later date. We're pretty opinionated that this is a permission system. There is a fair amount of centralization in it just because we know the blockchain ecosystem changes so rapidly. So we want to maintain control and be able to upgrade these contracts at a later date. A good example of this was, we built out this architecture before ERC 1400 was even a thing, and we had named some of the functions slightly different than the spec and the general consensus that was evolving over time. So we simply upgraded our token contracts to support the updated nomenclature. And so it's important to us to be this kind of this nimble in the early days, even if it allows some kind of centralized control. On our asset token specifically, everything is completely modular and completely configurable. So the biggest thing that we have on there are different kind of trade restrictions that you can point to, which are separate smart contracts that live elsewhere on mainnet. You can see the couple examples we have up there are for a whitelist validator, which restricts a particular token to only a subset of investors, most likely those that have gone through KYC and investor accreditation checks. We also allow the ability to completely pause trading with our pausable validator up there. Along with our asset tokens and the proxy in front of them, we then use AirSwap's exchange contract to complete our P2P swaps. So that takes one of our tokens and generally a stable coin, or you could also use wrapped ETH to do trustless swaps back and forth. One of the biggest pieces of feedback we got when we originally launched Meridia was that these old kind of more stodgy real estate investors were interested in trading real estate in real time, but they didn't want to be exposed to the volatility of Ether. So, one of the first things we did was to incorporate stable coins into the platform. So stablecoins can be used not only for our P2P swaps, but also for distribution issuance. So we have a distribution issuance contract up there that allows the property manager or the sponsor of a deal to distribute quarterly or annual distributions to all investors. We are using kind of an unclaimed distribution system. So the DAI payments, let's say if you're owed $100, will get transferred directly into your wallet without you having to log in and sign a transaction to actually claim it. Also in there, we have what we like to call our simple link registry. This just allows you to attach any type of metadata to a contract address. The most common one that we do is we just take a hash of the operating agreement and attach that to the token contract itself. So it's always verifiable what you're actually trading back and forth. We're also actively looking to integrate with other real estate providers so you have kind of a real-time data feed that you can always query for a particular asset, which is really exciting. So next I'm going to dive into these compliance validators a little bit more. So the ones that we built out today are whitelist validators as well as sender whitelist validators. Those are mostly used for regulatory reasons, again, for only restricting trading to investors that have gone through the right checks. We also have blacklist validators. The Treasury Department in the United States actually has come out with a pretty robust list of addresses that you shouldn't be transacting with. I believe they're mostly Bitcoin based, but we have a blacklist validator that you can apply to any of these tradable securities, so you're ensured that it's not going to go into kind of the wrong hands. Along with that, we have lockup periods, so automated lockup periods. So a lot of these securities basically have a 1-year non-trading phase, and so that's going to expire automatically without kind of any work on our end. We also do things like making sure that the investor count is below a certain amount in some instances or above a certain amount in some instances, and I'll go into the code for one of those in a second. And then also for real estate assets specifically, a lot of them don't allow any one investor to own greater than a 50% share. Otherwise, it triggers all types of operational control and changeover. And so that's a compliance step that is completely automated. And all these different checks, if they're attached to a token, are checked every single time a trade is made. And the trade will literally fail if any one of these rules are violated. So this is what it looks like in practice. So we originally called this function, I think it was validate transfer way back in the day, but then we amended the function name to can send to be compliant with ERC 1400. You can see what we're actually doing in here is we are getting all the modules that are a transfer validator, and we're looping through them and making a call out to them just to make sure that this combination of buyer, seller, token, and amount is valid. Those are the 4 parameters that you kind of put into all these validators, run a bunch of business logic and business rules to make sure all boxes are checked before you actually complete a trade. This is done not just for the traditional transfer function, but also for the forced transfer function, which we also support on our asset tokens, given there are certain instances where we need to be able to forcibly move these tokens around. For instance, if somebody lost their private keys, again, we're dealing with some not so technical, literate first customers on our end, or if somebody was to get hacked. This one's a little bit harder to see, but this is an example of, I believe, our investor cap validator, which actually gets fairly complicated logic. So let's say that you can only have a max of 100 investors in this one particular token. Most of the time, it's pretty simple. If you're way below 100 investors, go ahead and start, allow that new buyer to kind of get into the asset. However, when you start getting to 99 investors, it starts getting a little bit more complicated. Is the seller selling their entire share, or are they only selling part of their share? All these things end up being kind of like the nitty-gritty type logic that we've ended up putting in the smart contract. All these have been audited and are deployed to mainnet to date. So we get asked too, just more broadly than just real estate, kind of how, when is the security token revolution going to come? When are you going to see a price bounce as a result of it? And what I always say is that we're still very much in the early days, and there's still kind of a lot of infrastructure that needs to be built out before you're going to see tons and tons of securities moving to mainnet. I think Polymath is one of the ones that have kind of the most tokens out there, but we have, in the tens or hundreds of tokens that have been launched. You are starting to see more of an ecosystem pick up around this use case. You're starting to see companies like STOWise and Tokeny basically categorize a lot of the issuances that have happened to date. A lot of folks are trying to become that new kind of Bloomberg for security tokens, so it's interesting to see that evolve. Of course, there are some things that are slowing us down a little bit. The biggest one, of course, is custody. So you need to be a qualified custodian to hold these on behalf of institutional clients in most instances. And there are only 1 or 2 companies out there that in the US that are a qualified custodian and then also have fairly robust functionality for custodying crypto. So that needs to kind of evolve quite a bit before we're going to see more robust applications. I'm a big fan of DACC and BitGo on that front so far. Specifically BitGo, they have a great API to work with if you're doing some more kind of technical things with your smart contracts that you need to support. The next one is just institutional adoption. So we work with a fair amount of the biggest real estate players because they do see that this is kind of the future of their industry. They do believe that having a commercial property sale take 6 to 7 months in some instances is probably an outdated methodology, and they see blockchain as one of the main kind of new approaches that could lessen that time considerably. However, they need things like custody and they need regulatory clarity before they're willing to jump into the space. That's why we're watching Fidelity quite a bit. We're watching Circle quite a bit to kind of see some of their moves. I hope that wasn't because I mentioned regulation. All right. Thank you, everybody.
Okay, so there is some issue. We will have to evacuate the building.